Hello everyone, thanks for joining us. I'm David Stoney, Operations Manager at Rosecut, and I'm joined by our Portfolio Manager, Daniel Greenhough. How are you, Daniel?
I'm very good, thanks, David. How are you?
Yes, not too bad, thank you. So Daniel, obviously there's a lot going on right now, and we wanted to give our clients just an overview of the current situation with the conflict in Ukraine and how markets are reacting as a result. Could you tell us a bit more about that, please?
Yes, absolutely. So if you cast your mind back to the start of the year, what happened was the stock markets really started in a downtrend. People were concerned about factors like the Federal Reserve raising interest rates. In fact, at one point, they were worried that the Fed would raise rates by about 7 times this year, which is quite a lot. So we started the year with a bad January. And then, of course, what's happened is the Russia-Ukraine conflict has broken out, and that's really dominated headlines ever since. It's had a big impact on the price of oil, which has then had an impact as well on metals, agricultural commodities, and so on. Now, this is something we've been talking about for a few months. So those of you that dial into our monthly market updates, you'll have heard us talking about a seemingly bizarre subject as fertilizer prices. First time in my career I've ever talked about such a thing. But it's important because, of course, food production has a big impact on people and how much they have to spend, because you can't go without it. It's a very price inelastic good. So really, the upshot is we had a lot of trends which have just been accelerated by the Russia-Ukraine conflict, and it's led to a bit of a risk-off environment. So stock markets have continued to have some price weakness.
I suppose an obvious question on most of our clients' minds would be, is there any Russian exposure in our portfolios?
Yeah, it's a good question. And the upshot is not meaningful exposure. Now, within the emerging market equity ETF, there's been between 5 and 10% over the years. And this is a passive instrument. So it's not an active manager deciding to buy Russian equities. It's just what's always in there. Clearly, those stocks have fallen a lot in value. The worst case scenario is that they get nationalized potentially. And the overall impact on a client's portfolio, it's really minimal. I mean, the emerging market equity ETF would be maybe 6% of a portfolio. Russian equities, 5% of that. So 5%, 6%, it just doesn't make a big difference. So it's better to concentrate on your overall portfolio returns, and Russian equities just never played a big part.
Yeah, of course. Have you made any portfolio changes recently that you care to elaborate on?
Yeah, so we're recording this on Thursday, the 10th of March. And just over a week ago, we made a few portfolio changes. The upshot is that we moved to a more defensive positioning, and we took advantage of what I'd describe as a special situation. The overall allocations within portfolios, every portfolio now has 16% in cash. That makes them a bit more defensive and gives us plenty of cash if markets really fall heavily and we want to buy some more equities. So that's some great optionality in there. We also bought some index-linked government bonds. And by index-linked, what I'm referring to here is they're linked to the inflation rate. And the reason we did that was because with price of commodities going up and economic growth potentially slowing, the risks of a stagflation environment increase. And what I mean by a stagflation environment is an environment where economic growth is very stagnant, so very low, but inflation remains stubbornly above what the central banks would like. In that scenario, there's not many assets that really help a portfolio. You're looking at gold and maybe index-linked government bonds, and we went for index-linked government bonds to add a bit of defense against such a scenario. We also retained the energy sector ETF that we've had for about 15 months now, which has clearly been benefiting from the rise in the oil price. And the other special situation we added is an ETF that tracks the price of carbon, or to be more specific, EU emissions linked to carbon. And this is something we've been watching for a while. It's almost like a new asset class. And we've never quite had an entry price that we liked. But it seems that with the sanctions that have been imposed and the general risk-off environment, I think there were a few forced sellers in the market, and that meant that they were selling at a price that they didn't really like, but they had to sell. And that created a nice opportunity for us to initiate a position in the carbon ETF. So overall, more defensive with some upside participation for a smaller amount of equities and a couple of special situations.
I suppose taking all this into consideration and to wrap things up, what's the general outlook here? How do you see things recovering once the conflict ends?
Yeah, so for now, I would say the general outlook is still to remain defensive with respect to equities, with some upside participation in commodities or commodity-linked equities. At some point, the conflict in Russia and Ukraine will end, all being well. And it wouldn't surprise me if at that point you see a bit of a bounce in markets, because it's a very easy narrative for investors to get involved in. And so you could see a bit of a risk-on move where equities jump and maybe commodities sell off. That's certainly what we've seen every time you hear positive signs out of the negotiations. That, in our opinion, would probably be a good time to think about adding some direct commodities exposure to the portfolio, because we think that the market would then start to refocus on those longer term structural trends that we've been talking about. So, under investment in energy and the impact that's going to have over the next few years. So that's our base case scenario. We're watching to see how it develops. Yeah, that's it.
No, great. Thank you for your time, and that's really been helpful. Thanks, Daniel.
All right. Thank you, David.